All right. Hello, everyone. Happy Monday. Welcome to your market check-in here with myself, Greta Wall. I'm your host, and I'm joined by Derrick Oldensmith, the head trader at T3 Trading Group and leader of T3 Live's Pro Desk virtual trading floor. Before we get into any market-related discussion, here's just a quick look at Derrick's positions as of our recording here today on August 24th, 2026. Again, Derrick is the head trader at T3 Trading Group. Derrick, it is Monday. You and I haven't talked in a few weeks, but how is the start of this week going for you?
It's been an interesting morning for sure. Was down a bunch of P&L at one point this morning, mainly because of my swings in semiconductors and memory names that were gapping against me pretty hard. A lot of them have recovered really well, and we basically called out the low for a long opportunity and SOXX and the semiconductors, a few other names. It certainly wasn't easy this morning to be able to capture the bottom in tech, but we're kind of able to nail it. We bounced back pretty well, and at this point, it's going to be a pretty important close. 708 in the QQQ, I think is pretty important. We got smoked beneath that this morning, and now we've recaptured the level. So I'm really curious to see if we can get back above 708 on a closing basis or not. If we can close where we are or better, daily candle will actually be pretty bullish. But it's been an interesting morning just because it's post OPEX. I think that it created for. I mean, we've been in a market that's been very insofar as dispersion and rotation. They're always rotating uh, out of something and into something, and then the spies are staying relatively unchanged. But it was a heavy rotation this morning out of memory, out of semiconductors, into financials, into safety plays, even into certain Magnificent Seven names. But I attribute that there was no news for it. You had Sandus down over 10%, and there was no news for it. So I attribute that to post OPEX rotation market dynamics more than anything. And that's why today's close is going to be pretty important.
This obviously is a very important week for the market. The title of our stream today being Nvidia earnings week, because that is just one of multiple things happening this week, but definitely a huge earnings report coming Wednesday after the market close. Some other names also reporting on Wednesday: Salesforce and CrowdStrike, which the software names were like the redheaded stepchild of the market for a while, and then now they were leaders, and then the semis were leaders, and then the software was, it's just the back and forth between software and semis, it feels like. And then also Marvell reporting Thursday after the close as well. So a big week for both software and semis, obviously Nvidia being the highlight there. So for you heading into this earnings week, what's your focus, and where are you maybe wanting to play something or focusing or looking at these names that are reporting for some clues on where the market goes from here?
Sure. It's funny because it almost feels like there are two halves of earnings season now.
Mm-hmm.
Yeah, the first half with most of the Mag 7 companies reporting. Then you get like 2 weeks that are really boring from an earnings perspective, the last 2 weeks really. And then you get to the second half of earnings season where you still get some semiconductor names, memory names, Nvidia, Marvell. I think we're still waiting on Micron. You get a lot of the cybersecurity names. You mentioned CrowdStrike, so we're still waiting on a lot of those. So here we are entering our back second half of earnings season, and it's going to be important. We also have Warsh at Jackson Hole on Friday, which is going to be important to this market as well. So you know, the bear case for this market has been based off of uh, oil and interest rates, the TLT getting crushed, and now we've seen Scott Bessent have to step in and attempt to save the long end. The bull side of the market, I still think, is the AI trade. As we've worked through earnings season so far, I know that semiconductors haven't really traded well in the last 2 months, but there has been no cracks in the story here. It's still firing on full cylinders. So, on all cylinders. So this market being a little bit weak here going into the Nvidia report, I actually also think that part of the weakness in semiconductors today was a little bit of de-risking in front of Nvidia. But I think that sets us up for higher. If Nvidia has a good report, if this thing reports well and the AI trade goes back into full gear, we could very quickly see this market back at all-time highs.
You beat me to it. I was going to talk about some of those other things going on, so we'll talk about them for sure. The Bessent news this morning, or that he could tap the nearly $1 trillion in the Treasury General account to fund bond buybacks. What kind of impact would that kind of action have on the market dynamics that we see at play?
So increasing interest rates is a big problem for this market, and the market is naturally increasing interest rates. People
Right.
are selling down treasuries really for two reasons. One, because inflation is high, so they're expecting that at a certain point the Fed may have to hike in order to tamper down inflation. And every time we see further escalation in Iran, further move higher in the price of oil, that is transferring through to the TLT getting hit and rates moving higher. Uh, Higher interest rates, um, it reduces the PE multiple of the market. So basically, you trade at a cheaper general PE because there are other alternatives. So, pretty simply put, let's say that you're an investor out there and you're thinking about your different alternatives on what you want to do with your money. If you can expect that the stock market can, on average, give you a 9% return on your money, but with a ton of volatility. You might have a 25% up year, you might have a 20% down year, but in the long run, it'll give you 9%. At what discount would you be willing to take a smoother return with a little bit less risk? If let's say you're looking at an alternative of 7% and it's relatively risk free because you're buying U.S. government debt, and obviously 7% is not an option. I'm just using this as an example. Well, a lot of people are going to be interested in taking their money out of the stock market or not investing in the stock market because they can get a 7% steady risk-free return. Sure, you maybe can get 9% in the long run in the stock market, but it's not risk-free. There's going to be a lot of volatility to it. What if this year is going to be a bad year and you're planning on buying a home or something like that? So the higher rates go, the more alternatives that people have that can be safer for their money, which therefore brings down the forward PE multiple that the market is able to trade with. So that is one. Two is particularly when it comes to small caps or medium cap stocks, they're heavily reliant on raising debt for their ongoing operations. So basically, their cost of business, their cost of capital, it becomes significantly higher in order to actually be able to run their business because they now have to borrow at these higher rates. And I like to use an example of like an Uber. I don't know that Uber ever would have been able to exist if it wasn't basically founded in a period of time when interest rates were at zero. So they could spend years and years and years just borrowing money for extremely cheap to try to build out this business to eventually hit a point where this could become a viable, profitable business. And they were able to do that because they spent most of their infancy as a company in a decade of more or less zero interest rates. But if they got started in a period of time where they had to borrow at a significantly higher rate, that company may never have been able to truly get off the ground. So it has a disproportionate impact, higher rates on like the IWM, on small caps and on mid caps. So keeping interest rates under control is really important. It seems like the White House has made it clear that we're not getting out of this Iran mess and that we're not going to just fully get rid of tariffs, which are the two biggest inputs, in my opinion, on inflation being higher. So they need to they're beginning to implement some degrees of financial engineering in order to try to keep specifically the long end of the curve um, not higher than 5% is really what they're looking to do. So that started with what they're calling this Treasury twist, where basically they're going to be on the bid for long duration Treasury bonds while selling shorter duration. So the amount of debt doesn't actually change, but the issuances do, so that they're able to kind of control that riskier long end of the curve. The next step, if that doesn't work, and we saw it, the market immediately basically sold the TLT down. We had a big pop in the TLT, so interest rates went lower. But 2 days later, the TLT was all the way back down. Interest rates were working their way back higher, and the market was kind of saying, this little twist operation here is not enough. And now we're seeing this morning, Besson coming out and basically saying that there's a potential that they could actually just outright buy treasuries, just beyond the bid to control it. So this basically becomes more of a form of quantitative easing, where they're using this capital to just buy it themselves. And it's interesting because they haven't said that they're going to do it. All they've said is that they can do it. And I actually really like that tactic from Besson. I think it's smart. It really it's a playbook out of like the Ben Bernanke Fed of just being really providing a lot of clarity on what the next steps of the Fed are going to be able to do, because it's like if you set certain expectations, the market's going to move based on those expectations, even if those expectations don't come to play. And all that they really need to do is achieve their end result, whether that comes from being forced to actually implement these purchases or just chattering that we could do it. I mean, who the hell wants to be short the TLT? Who wants to be short the long end on bonds right now if there's a potential that the U.S. government could step in and buy $1 trillion worth of them? Certainly not me. So that in and of itself helps their cause. And now, of course, from the perspective of the Federal Reserve, Warsh seems to be trying to move away from that transparency and losing that tool for whatever reason,
Mhm.
and not really providing what the next steps are going to be. So that's kind of what's going on right now, and it's obviously interesting timing. But the best thing would be if we just ended this war, because this is the root of the problem. But there doesn't
Mm,
seem to be an off ramp. Is the issue?
yeah. The like you said, you don't necessarily have to do these things for this market to react the way they want. There's definitely feels like there's definitely been a lot of we'll hint towards something or we'll say we're going to do something and see how the reaction goes, and then not actually have to do it. It reminds me of Besson's note that they kind of purposefully let be seen a few weeks ago about the yen and buying the that didn't necessarily happen, but the market saw the note. So there you go. The We get inflation data this week ahead of Warsh at Jackson Hole on Friday. So this will be Warsh's first Jackson Hole event. Of course, a key speech for the Fed chair every year, but definitely important for the market this year because of Warsh, this being his first one. The PCE price index will be out on Wednesday. That's the Fed's preferred inflation gauge for now, unless Warsh makes changes there. But definitely some important inflation data coming ahead of that. And so, we talked about Besant and all of that, but now the Warsh side of things. Just go into a little more detail on what you think the market is looking to hear from Warsh on Friday. Obviously, we can't predict what he's going to say. But
Sure.
what
Yeah.
could the
So
market
so
want?
what the market wants to hear is that he's not interested in hiking.
Yeah.
That's what the market wants to hear. Now,
Mm-hmm.
whether that's the responsible thing or not, sometimes fiscal responsibility means doing difficult things and making difficult decisions that can hurt in the short run, but are there for the longer term benefit of the economy. We did see on the last Fed meeting, and we recently had our Fed minutes. I don't remember if it was last week or the week before that. I think it might have been last Wednesday. We had 3 dissenters come out and said that they wanted hikes. They wanted a hike to get ahead of things because inflation was too high. And again, every time you see an escalation out of Iran, every time you see oil tick higher, you are further kind of feeding that beast. But we saw Besson come out also on that last Fed meeting and basically say I'm going to fight inflation, but I'm also not hiking rates. Which a lot of people were scratching their head. Well, how do you fight inflation if you don't raise rates? So that is kind of to be seen, and we'll see what type of language you can throw at us and what the message is going to look like. That's for the stock market. I have to remind my traders sometimes, like inflation in and of itself is actually good for the market. Inflation makes the price of everything go up. So it makes the price of your assets move higher, as it makes the prices of your used cars and your groceries move higher. Inflation in and of itself is not necessarily bad for stock market prices. What's bad is one, the instability that it can cause, but two is the need for higher rates in order to actually fight that inflation. And then that circles back to the conversation we were already having about what that does to PE multiples. It slows down the stock market. And the other thing that you have to remember about the stock market being at all-time highs is that that creates a wealth effect, which also further stimulates the economy. So if you go into a 2022 period where the Fed responsibly, under Jerome Powell, raised rates through the roof in order to fight inflation, and they were extremely successful for it, we had to endure a pretty long duration bear market to get us through that period. But it was the right thing to do for the economy. Take some short-term pain for long-term gain, and then by the end of 2024, inflation had gone from 9.1% to like what was it, 2.6, 2.8. Just an incredible move lower. But we had to deal with a market that was off of its all-time high, that was 20+% down for well over a year before that high was retested. But again, that is what fiscal responsibility looks like at the economic level. We are just increasingly becoming a society where we just don't even want to deal with the slightest amount of pain, even for the shortest period of time, even if it's going to benefit us in the long run. And that's a scary thing on what it could turn into.
All right. All right. So you and I, we talk about your stance on this market every time you and I are here. You were bullish the last time we talked, but that was, I think, 3 weeks ago. You and I had to take a break for a little bit. So what's your stance on this market now? Are you still a bull? Or are you waiting to see what happens this week?
Sure. I would describe myself as a cautious bull. One is that the market technicals are primarily intact, and that's what I'm going to take my cues from first and foremost. As long as the market technicals are telling me that I should be bullish, then I am going to remain bullish. But I'm trying to stay light on my feet right now. I think that the AI trade, which is the most important trade, got to keep in mind all this bad stuff that we've spoken about, the fact that rates have moved higher, the fact that inflation has moved higher, tariffs, all the bad stuff is being offset by a lot of positives. And we didn't really talk too much about the positives, but the biggest positive is that the hyperscalers are basically stimulating $1 trillion a year into the economy through their AI spending. And that is massive. And Meta, as just using one example, but it really applies to all of them, doesn't really care about the price of oil. Like, they're so far removed from that. They don't have, real debt issues, though you could make an argument that now a lot of the hyperscalers are increasing their debt load in order to continue to spend. But these things are cash flow machines. So they can continue to spend what they earn, and their businesses are fairly far removed. It's not impossible in a massive economic slowdown for Meta and Google's business to be reduced, but they're pretty far removed from higher oil prices leading to a slowdown in revenue for Meta or Google at this point. So the bull case is still very much there. The thing that makes me take pause right now, the thing that has me wanting to be light on my feet, is seasonality concerns. We are entering pretty much right now the one of the tougher parts of the year. September, I believe, is historically the worst month for the stock market. October is known for its volatility, and really, it's in the back half of August, post August OPEX, which was last Friday, when things structurally typically begin to deteriorate. This is especially true in a midterm year. The midterm year is typically the worst performing year from a stock market perspective of a 4-year presidential cycle, and you typically see a real rise in volatility and the VIX and some reduced liquidity in the volatile months that already tend to be weak going into the midterms. So break it down. While the technicals are still saying that you can be bullish, I am being cautiously optimistic. I'm being cautiously bullish. I think big picture, any major dip in the AI play is viable in AI and in semiconductors, in memory related names. I think the big picture, that trade is still there. Um, But in the small picture, we got to be a little bit careful and kind of navigate these through these few months. And I would also just note that uh, post the midterm into the end of the year on a midterm year is typically very strong. So we get this kind of tougher few months here that kind of begin right now historically, and then that feeds into a really good end of the year once we get past the kind of the midterm risk, we can call it. And that's why I think overall, as long as the AI story is still intact, which everything is pointing to that being that way, a bigger picture pullback in this market. If we were to get a 15% pullback, I think it's going to end up being very viable. So I bullish, but light on my feet would be the best way to describe my approach right now.
All right. Bullish but light on your feet. Any setups that you like in this market? Any charts you want to go through?
I really want to see how we close today. If you want, I can pull up my other screen here. Just give me one quick moment. Let's see here. Where is that button? There it is. Share screen, entire window, that one, boom. All right, you should have it now.
There we go. They're up.
Cool. So just real quick with this market, right? A little bit of a technical pullback with the SPYs, but we just had a huge breakout on the 755 to 760 area. So bigger picture here, kind of describing the bullish but light on my feet, as long as the technicals are still saying I can be bullish thought process. As long as we're holding above the 755 to 760 breakout zone from this 3-month consolidation, the technicals remain conducive to the long side of the market. If we could close well today and have a nice little downside tail on this candle that could set us up for higher as we go into the Nvidia report, obviously that's going to move things, and Jackson Hole is going to move things, but it could be a conducive initial setup to be long. Qs are a little bit more neutral, a little bit more precarious. They are still within the range of that broader 3-month consolidation. They had been looking a lot better in the beginning of August, but a little bit of a deterioration in the semiconductor trade kind of weakened this out a little bit. We had huge support, I mentioned earlier on the show, 708. 708 is a really important support level here for these Qs. Beneath that, there's a gap. Today, we actually almost filled that gap, and now we're back above 708. So if I can get a close that is 708 or ideally a little bit better, this will actually be a nice looking candle that maybe can get us to work our way back up to 720 and beyond. Again, the big asterisk there is going to be what the Nvidia report does to semiconductors in the Qs, because it can have a big impact if there is a big move. And interestingly enough, like the IWM has deteriorated, but the RSP, the equal weighted S&P, has been trading great, and that circles back to this rotation theme. So it's like today, when you were seeing bigger weakness in semiconductors and you were seeing bigger weakness in memory, you were just seeing the financials rip higher, and you were seeing consumer staples pretty well again, and XLB, XLB, XLB. XLB was green this morning. That's deteriorated a little bit as the semiconductors have improved. But again, that is just the story of this rotation. So I think as long as we're rotating out of one sector and into another sector, there's going to be something out there that holds this market up and keeps us generally bullish. But just watch to see if we were to get a day when correlations really increase and they sell everything down. And the VIX is an interesting spot here too, because you could actually see this VIX rip. If the market were to rip higher, you can see the VIX rip higher from where it is. But if the market were to get destroyed at a certain point, that this VIX would probably break up as well, and that might be with an increase in correlation. So in order for me to get bearish, I want to see correlations increase on the way down, not just SOXX or DRAM being what's selling, or MAGs being what's selling, not just having one thing that's weighing on the market that day. I want to see everything sell while the VIX moves higher and while the SPYs lose that like 755, 760. If we get that, that's a big warning signal where you need to take your foot off the gas of this market, hedge yourself out, flip short, do what you need to do. But for the moment, we are still okay here, and I am really watching the memory trade, because I do still like this trade a lot. I've been watching this like 54-ish support, which similar to the Qs, we traded below that this morning. We're back above it now. If we could get a decent close in the Qs, if we could get a decent close in memory, then this actually becomes a little bit of a false breakdown. From a false breakdown, you could get a move higher, pretty similar to how the SPYs had a false breakout, and that actually led to this deeper price correction that we're in. So I'm watching that, and I'm also really watching these Mag 7 names. I like them, especially if MAGs, the ETF, can reclaim 68. Some of these are going to be looking pretty good. I like Amazon long a lot. Jeff Bezos has been on the offer that's been driving this thing down, but I like this. Amazon and Microsoft were the best two earnings reports out of the Mag 7 stocks. So I do think that these are stocks that you can still own at this point. Microsoft also, I don't have a position in that one right now. But Microsoft looks great today. Got really, really extended post that earnings report, put in the shooting star, pulled back, gave us like a 5-day sideways movement within this equilibrium zone, allowing the 21 EMA to catch up. And now this thing is turning back up. So again, this was about rotation. You got Amazon going today, you got Microsoft going today, but you got the semiconductors getting smoked, and you got this memory getting smoked. But underneath the surface, they're rotating things so that the SPYs can trade down 0.2%.
All right. And speaking of the memory trade, you said earlier we still have the Micron report to come. Micron doesn't report till September 22nd. It's crazy.
Wow, it's really
just
that
like
late?
so late. Yeah. I think it's literally the last week of earnings season, and then we start earnings again in 2 weeks after that, or 3 weeks after that. It is crazy. So,
yeah, maybe
so
we
late.
should just say that Micron is the beginning of the next earnings season instead of the end of this one at this point.
Yeah. All right. So a lot could change between now and September 22nd. But again, this week the big names: Nvidia, Marvell, Salesforce, CrowdStrike, some others, of course, as well. But a big week for this market for sure. The big dog Nvidia is reporting, and Nvidia hasn't been the big dog so much in this space anymore. But with recent news, they're definitely trying to say they still are. All right. Derrick is a real trader, so I want to let him get back to that again. Derrick is the head trader at T3 Trading Group. So if you have any interest in working with him and the team there, you can go to t3live.com/DOLive. T3 Trading Group is a prop trading firm. Lots of benefits to working with them. One of those being that you get to work with Derrick every single day inside the ProDesk virtual trading floor with him and his team. So again, t3live.com/DOLive. Derrick, have a great week. Hope it's a busy, exciting one for you and the team. We'll talk next week.
Thanks, Greta. Talk to you soon.